Welcome to Deal Talk, a private equity podcast by Moonfair. Each episode, our CEO, Dr. Stefan Pauls, sits down with leaders from across the industry to discuss their views on the investment landscape, working with portfolio companies, and the lessons they've learned.
So with that, I want to turn it over now to Moonfair's founder and CEO, Dr. Stefan Pauls, who will introduce our guest.
Thank you, Pablo. So I'm delighted to be here, and a very warm welcome from my end for our Deal Talk today here. I'm very much delighted to have you all here, and I must say I'm overwhelmed about the interest for the format that we are seeing. I'm counting 230 professionals, and the number is still increasing, attending the webinar today, and I'm convinced this is due to the fact that we have an outstanding executive from the private equity industry with us today. And I'm talking here about Markus Brennecke, who is our guest today. Markus is a private equity veteran, and I'm not exaggerating by saying that he has been clearly shaped the private equity industry in Europe over the past 15 years. Markus is partner and co-head of EQT's global private equity advisory team, and moreover, he is a member of the Equity Partners Investment Committee. He's chairman of the Portfolio Review Committee within EQT, and he's also head of the Industrial Network. The deals Markus has been leading are numerous, and they include landmark deals such as Tognon Group, BSN Medical, Kabel Baden-Württemberg, and many more, just to name a few. But there's more. As an entrepreneur, Markus has been part of the amazing success story that EQT as a firm has written. When he joined EQT in 2005, the company was, I would say, a boutique private equity firm, a couple of offices across Europe, and a single-digit billion number in assets under management. Today, we are talking about a firm that manages more than 50 billion in assets under management, with 700 employees in 17 offices globally. I personally find this story amazing. So Markus, a very, very warm welcome from our side. So delighted to have you with us here today.
Thank you. Very nice words, Stefan.
Before we get started, just a few process things to mention. We're going to have now 20-25 minutes for questions between from my end and the discussion between myself and Markus. And at the end of the session today, the audience, you will have the opportunity to ask questions. So please type them in as we speak. The team around Pablo and Zeke will then pick the most relevant ones, those that have been mentioned most often. Every question that will remain unanswered because of time constraints, Markus kindly offered to answer after the session. So let's jump into the discussion. And the first topic, Markus, I want to discuss with you is around macro and around inflation. And more and more in the past, over the past couple of weeks, the concerns around inflation have been rising. And I'm simplifying a bit here, but four factors that stand out from in the discussion more and more. One is the unprecedented amount of fiscal stimulus that we are seeing, and we are talking here about announced measures that count for more than 20% of global GDP. Just for the US alone, we're talking about a number of 5.9 trillion that has been announced since the pandemic began. Then, of course, we have the monetary easing. Many people say the low to zero or negative interest environment is here to stay, and it seems that there is no real hurdle anymore from the central banks. The 2% inflation cap is not set in stone anymore. So we will very likely will continue to see monetary easing. But there are also deflationary factors that come to play. One of them, of course, globalization. The value chains, production is going to the lowest cost areas globally, and of course, we are seeing digitalization, which its impact on productivity gains in more or less every and each industry. So let me ask you, what is EQT's view on macro, on inflation, and what do you think we can expect this year and going forward?
Yeah, I need to disappoint a little bit with your first question because I'm not a macro expert, but still, my strong belief is this cannot last, this current environment. Of course, as you pointed out, the liquidity is there to look for yield. But I do think that the current environment is unhealthy. And honestly speaking, the valuations, including the SPAC boom, for me is not sustainable. And it feels a little bit like the IPO windows are starting to get shaky in the US, particularly for high growth revenue multiple-based tech companies. Yeah, they were down 4 to 5% on average yesterday at Nasdaq, and notably some of the high-profile IPOs, take Oscar Health, are not working. They are down, I think, 30% since pricing in early March. Therefore, the institutional long-only accounts like the Fidelities and BlackRocks essentially went on a buyer strike yesterday and decided to take a breather. And the hedge funds, which you need to drive momentum in order books, also weren't buying anything. So I'm not saying it will go down. I don't know, but I am sure it will be very bumpy from now on for the remainder of the year. And then, of course, we always have these geopolitical risks, which we see all the time, being Brexit, being US-China trade, and so forth. So I must say, I think one needs to be careful. I personally think it's getting very thin ice.
You were talking about public markets. When we move to the private world of things, we all have seen an unprecedented value creation happening in private markets so far. And just a few stats here to illustrate what's happening. Since 2000, buyout asset value has grown 3.5 times faster than public markets capitalization. Companies are staying, you said it, private for much longer. Maybe this is also a reflection of the exaggeration than in public markets. We see, that the opportunity set in private markets is approximately, and now I'm talking US data, 10 times larger than in public companies. And we are seeing a 50% decline in publicly listed companies in the US again since 1996. So do you think this trend of these unprecedented value creation in private markets is going to continue as a general trend, and that as an investor you have to play private markets?
Yes, Stefan, I'm convinced that you need to play the private markets, as the public markets can be, like always, can be volatile. In a private setting, we as an investor have much more freedom to act, as I sell parts, do lots of add-on acquisitions, work on operational excellence, and without looking at sort of market reactions. Of course, the public markets will always be important, and we need to play them either with public to privates when valuations are attractive and lower, or exits when valuations are high. And that is what we do with our buyout funds, obviously. But we also have, by the way, a constructivist fund, how we call it, where we take stakes in public companies and drive value creation from that perspective. So we have been pushing, obviously, exits in this current market environment and being a careful investor, obviously, in buying assets. But yes, my strong belief is one should play the private markets.
Markus, let me ask you a difficult one. And we all know that you should not time your investments and rather invest across cycles. And also there's empirical evidence, by the way, that private equity best returns tend to follow recessionary periods. But given where we are, and you said it, the valuation levels that we are seeing, the high volatility in the market, and referring also to the record amount of dry powder money that is out there, but also the money that is put to work as we speak. Do you think, does EQT think the time is now really right to place such huge bets?
I don't think we are placing bets, to be honest. We are a thoughtful investor, like some of our dear colleagues. But let me give you an example. We've decided a few years ago to focus in our buyout fund on 4 core sectors, being healthcare, being technology, being services, and industrial tech. And by the way, we deprioritize consumer goods. Not that I'm saying consumer goods is per se not good, but we decided not to invest into consumer good anymore, because you have the Amazons and other ones who are of course very strong. In our last 3 buyout funds, healthcare and tech was roughly 65 to 75% of the portfolio. just before COVID hit us, the entire portfolio was growing 20% top line and roughly 20% bottom line. So in a low GDP environment, we had very nicely growing companies. And on the other side, when COVID hit us, we had a very resilient portfolio in these two mainly these two sectors, obviously. So it was also downside protected. So we have been always strong in crisis at EQT, also in the financial crisis. And our guidance to our team was exit as much as you can in this environment, as I said before. And of course, we've also invested in growth themes along our 4 sectors and had to pay high prices. Yes, but we rather pay a high price for a good company in a growing market than a lower price for a not so good company in a more challenged market, and try to develop this good company to great, or a great company to an awesome one. And we invest with the trend and are not bottom fishers or buy into cyclical companies. And therefore, our investors, including Moonfair and their customers, had, I think, trust and gave us in our COVID fundraising, which only started in Q1 last year, and gave us 15 billion euro of fresh money for EQT 9, which we very carefully invest.
Thank you, Markus. I must laugh a little because last time when you and I spoke in private about the SPAC phenomenon, I said, look, I will not bring up the topic, but my team forced me to do so today. So talking about SPACs, and you mentioned it, which became a mass phenomenon. And just again, mentioning a stat here, they are standing for more than 50% of all US IPOs last year, and there's no day without the news about the new SPAC. So some are seeing this as a huge bubble, but other industry watchers are saying and counting SPACs as real dry powder for the buyout industry. And some are even saying, wow, this could become a threat to the established private equity industry. And some are even going further, saying this will threaten the famous 220 model. So are you worried about the SPAC trend? Are you seeing them as competitors, or do you think this is, a short-term phenomenon that will disappear fairly soon?
So first of all, and sorry for being so frank, but I'm not a SPAC fan. And why? I don't like the fee model. And that's also the reason why I don't like hedge funds, where they can make billions in one year and the following year might have a disastrous performance. I think incentives need to be aligned with the investors. And I believe in recent SPACs, like the one I think from Lakestar in Europe, this has been addressed. So that's I think a good good development. We at EQT have decided not to be a SPAC sponsor because we believe this is rather for, let's say, financial engineers, not company builders. Would we exit to a SPAC? It depends who the SPAC sponsor is, because we have a responsibility for our companies and employees also beyond our ownership. And therefore, we also care to whom we sell companies. So this is not a romantic comment. It's really a realistic one and a factual one. And finally, I believe that the SPAC boom will not last. Bankers have told us that the SPAC market is trying to, or is starting to crack, because the de-SPACing events aren't getting the stock price pop-ups they are used to. So this will negatively impact the demand for new SPACs. And that risk of attitude will start impacting also the general IPO market. So look, competition has always been there. We are never short of competition, and they're always, then the pension funds go direct and so forth. And this SPAC boom comes. No, I'm not. I'm not afraid in losing against a SPAC. And as I said, I'm a little bit critical, to be honest.
Let's turn back to the established industry. And you, of course, know this. Top-tier private equity funds in the buyout segment have generated returns north of 20% in terms of IRR in the past, net talking, an incredible performance. And EQT clearly belongs into this bucket and stands out here. And there's also the famous relatively constant gap between private market performance and public market, which is around 8%, called the illiquidity premium. But in your view, and based on your experience, and in these days, what is really driving and will continue to drive going forward the outperformance that we are seeing from the best buyout funds?
Look, my personal view, Steffen, is that the top-tier buyout funds always try to work hard to improve. And to give you some examples, driving operational performance in a very active way, i.e. we with our 500 plus industrialists, by the way, the broadest and deepest bench of industrialists, ex-C-level people of the whole PE industry worldwide. Our house of value creation, which we have with 33 levers, but which we have now developed further to standard levers like purchasing, SG&A, HR, but then sector-specific value creation levers in technology, in healthcare, in each of our four core sectors. Secondly, playing very well the M&A agenda with divesting and doing add-ons. Look at our company IVC, which was started as a local Swedish pets clinic and is now Europe's largest clinic with, 1,300 pet clinics. And thirdly, being able to do P2Ps when valuations are attractive, as I said beforehand, and IPO and exit evaluations are high. And doing that, very rigid and improved processes, etc. So that's my summary.
No, look, Markus, this is resonating very well also with our perception and view on the industry. And what you say is basically backing what Henrik Kravis said very early in the 2000s when he said the famous quote on financial engineering is over. And this is really important to understand that today, as you say, 72% of the entire value creation in global buyout performance comes from EBITDA and sales growth. Exactly because of the global playbooks and globalization capabilities the firms bring to bear. At EQT, you have, in addition to this, a very special and unusual, in my view, governance model called the Troika. Can you explain the audience a bit what's behind there?
Yeah, I need to go back a little bit to explain how the Troika is embedded. So first of all, I think it's a lot about not so much about the what, but rather the how you drive performance. And as I said, we today have more than 500 industrialists, and more than any other private equity company. And we started this industrial approach already in 1994 when Wallenberg family founded us, with ex-executives from ABB, Atlas Copco, AstraZeneca, Ericsson, etc. And we've continued to develop that. So these industrialists help us in due diligence next to the Bains, BCGs, and McKinseys and others. And in every pre-deal work, approximately 3 to 10 industrial advisors are involved. And they also they go to the management presentation and they write a memo directly to the investment committee. And once we own a business, the advisory board consists always of 4 to 5 industrialists with specific and relevant competency and knowledge and complementary expertise. The chairperson always being, coming from the industry, never myself or another EQT colleague and partner, which means we empower these industrialists, and consequently the board meetings are very content heavy versus financially orientated. And next to these approximately 6 board meetings per annum, we have a monthly physical, sometimes if needed bi-weekly or weekly, Troika. So now coming to your point, which consists of the CEO of the portfolio company, the chairperson, and the EQT partner. And this Troika is informal, is doing sort of follow-ons. The CEO can discuss HR topics and in a very open way without his colleagues listening, and even can say, look, Markus, you are much too intense now, please, can we reduce the frequency, or Mr. Chairperson, please do not be a super CEO, I'm running the show. But it's really a very open open discussion forum and very informal, and therefore there are no political games also. So in an underperforming company, the CEO cannot play and hide and speak then to the chairperson and then a little bit with other information to the EQT partner, because it will always be together, and that is therefore it's really about this not being only financially driven and with financial whiz kids, but really having industrials really involved and having this troika, which is there's just one truth, and it's an open dialogue, and it's informal, and it's also a good tool for the CEO basically. My view is if companies underperform, and that goes back to the industrial approach. If companies underperform, then normally the financial business professionals at a PE company, they then start to get nervous and they want to have another analysis and another analysis. But that doesn't make the company better. You need to have people who know an industry and have really experience to give the right expertise and be a right sparring partner for a management team.
Extremely helpful, Markus, and thank you so much for the insights here. Look, moving to another topic, and ESG and impact investing, this have become a standard in the industry. But you are known as a fund manager that really actively uses impact as a filter for certain deals. When you think about the broader discussion and the conversations ongoing in the industry, what in your view is missing in the mainstream discussions on the topic in these days?
Yeah, I think it's a very good question, Stefan. What does not work in my book is that that a PE fund has one impact fund and believes, look, this is I please my customers. I put a nice ribbon and nice packaging around my whole PE approach. I think that's not enough. I think we have an obligation to really take this serious, and that means, at least for us, as you said, we are really purpose-driven. We want to future-proof every company, and we take it so serious that we went just now through a purpose journey with all the partners, discussing the topic. And I spoke in front of in November in front of all our chairpersons and CEOs and said, you know what, I don't want to do once I retire to do something good, whilst I can do it now, where I have probably more influence and more impact with our portfolio companies. So it really needs to be ingrained in yourself to really drive something. And therefore we said we need to take it so serious that we not only drive it for our portfolio companies, but that we want to be a leader in our industry and even more. And to give you one example, we are pushing our suppliers to take the McKinsey, Bain, BCGs, the auditing firms, the law firms. We are asking them to have at least 25% of female on their teams, otherwise they will not get a mandate. So we are pushing even our advisors on for instance, the diversity topic. So it's something really that it can't be only sort of, the packaging and yes, I do impact fund because I can raise $1 billion. You really need to live and work it every day. And even in small stuff in your office, have a green energy like we have in all our offices, or that we don't have anymore the small Nespresso, but beans and all the waste and so on. So it needs to be a work and obvious decisions and lead by example every day, and also when it comes to the portfolio company. In my portfolio performance review, after the exec summary, I always attack the ESG topic before current trading or any other thing on the agenda, so that people also see that we take it from the top, that we really take it serious, and that we wouldn't do deals also like we wouldn't invest into betting or whatever. I'm not saying that you can't make good returns, but we want, we are there very, very clear with this very clear filter. And I hope that our industry will also move further very, very fast.
Markus, let me say, I find it impressive, the passion and conviction behind this topic that you bring across. Let's move, so that we have time for the Q&A in a few minutes, to a couple of more personal questions. And one is around advice, so to say, for younger people. If you would go or could go back in time, what advice would you give your younger self? What would be different?
First of all, I don't think you can be a good investor if you don't do mistakes. And I was a little bit lucky that I did mistakes when, in the early days of investing, so they were not so costly and not so large, but it's important. We need to allow people to make mistakes. I would say be curious, stay humble, very important point, also towards the portfolio companies. Be a team player and not ego-driven. And then I have one lifetime learning point, and that is listen to different people and opinions and connect the dots. And I think probably, I guess that's one of my strengths, that I listen carefully to people and then try to connect the dots and form then my own view and get different perspectives. And I remember having a lunch before COVID with a business partner, and I didn't like this personality, to be honest, yeah. But I still did it. But the but is, when listening to this person, there was one piece he mentioned which I found very smart, and that was then my takeaway. So even if I didn't like the personality, I took something with me, and that's something where that I would encourage people to listen to different perspectives. And therefore also I think the diversity point is a very important one, just because you get different perspectives and therefore come to better conclusions and decisions. And I think that is what I would give as an advice.
Markus, you had many successes as a private equity executive. We talked about it, but there's also another area where you had last year, I think I remember, a terrific success, which is in sailing. So what can you tell us, how did you get into sailing, and what is your most, win you're most proud of?
First of all, my father was a sailor, and I used to sail as a young kid with my father and my mother and my sister in the in the Danish archipelago. So I basically know every harbor in Denmark and partly Sweden. Then when I turned 15, I wanted to have a sort of a moped, a motorbike. Then my father said no, and he gave me a sailing boat. So I then started to race, and then I raced in the German team, Admiral's Cup and Sardinia's Cup, during university time, etc. Then I stopped when I started working, and I didn't sail for many, many years. And when I got unfortunately divorced, I started to sort of think about again my old passion, and I started sailing again. And then I sailed in a smaller boat, Dragon, and I was lucky with a good team, won 3 German championships, and I raised some medals in European and World Championships. Then I last year, as you said, started on a larger boat, formed a team first of all, then decided to buy a boat. Then trained a little bit more, so worked a little bit harder probably than my competition. And then luckily winning the main events, including the World Championship in October. And the important thing about that, it's a team sport. It's a passion. It's a good also balance in life that you have whatever passion, but that you have a passion. And the sailing gives me fresh air and this team approach, because everyone on the boat, of the 12 people of the crew, and also on shore, is important. Everyone is almost as equal as important. So it's a really team effort, and that's what I really enjoy. And lastly, I think success can be planned.
So insightful, Markus. Before I hand over to Pablo for the Q&A, here's my last one. If you had to summarize your time at EQT in one word, what would it be?
Amazing. Why am I saying that? I've been very grateful to, over the years work in such a great culture, and with really 15 years with great colleagues. I was only probably, if I look back, perhaps annoyed. You always, sometimes you're annoyed. So I was probably annoyed only 5 to 7 times in 15 years, or more than 15 years. And I think that is possible, positive. I think it was a splendid journey. I had some setbacks. My biggest setback was that I lost Scout 24 against a competitor, Hellman and Friedman. I worked extremely hard on that one. On the other hand, it gave me again a really hard drive to win the next corporate carve-out, hearing aids from Siemens. So probably I might have not won that one if I have not lost Scout 24. So superb culture, very rewarding journey, superb culture, great team members, and especially the younger colleagues. I'm very, very proud when I see that the younger colleagues who I know since associate, and they develop to really great investment professionals and successful deal makers. That makes me very proud. So amazing.
Terrific. Markus, thanks so much so far. Handing over to Pablo, because I'm seeing that the questions really are pumping up one after the other in our chat.
Yeah. Yes,
so
we have.
We don't have time to cover everything, but at least that we give the audience a chance.
Absolutely. Let's get into it. So our first question for Markus: how should investors think about allocating to your funds via Moonfare versus buying into EQT stock?
Look, buying into the stock is obviously, how shall I say? It's you get basically a platform, meaning everything in private capital, from venture to growth to buyout to a public value fund, this constructive fund, to real assets. Whilst via Moonfare, you can, so to speak, choose to be in buyout or Asia or individual funds. So the one is, let's say, more tailor-made according to your appetite, and the other one is rather the sort of overall EQT AB with everything. And it has obviously stock market exposure, at least what you said, that can be volatile.
Good. Next one, what will the PE industry look like in 10 years, considering the large amounts of capital as well as competition driving down returns?
Yeah, that's a very, very good question. I personally, people will, there will be, of course, write-offs, that goes without saying, over time. And I think you need to be always sophisticate and really work on additional improvements. We have this saying, everything that comes from our founder, everything can always be improved everywhere at all times. So always think about incremental improvements. So we have our returns in the buyout space is still above 20% how we price it, but obviously there are core funds and they have lower return requirements and longer hold funds. So we will see more of that, I believe. And what Stefan alluded to beforehand, this private markets. In the old days, we decided to sell earlier some of our companies, and I personally think that we see that also, the phenomenon that people hold on longer funds to their very attractive assets and put them into continuation vehicle or so. So we will see more of that to ride the winner, so to speak. That is, I think, as I said, the SPAC phenomenon will be reduced again, and there will be some other fashion elements coming up. So, but I do think that the strong and large funds will be strong also in 10 years. So I don't think you will see different than in the tech industry, where some very cynical people will say Oracle and SAP, they will be overtaken by the newcomers, some newcomers we don't even know. And you've seen the Tesla. I'm not so sure that will happen in our industry, to be honest. I don't hear you.
Sorry, here's one from Markus and one that Stefan may want to weigh in on as well. Benchmarking PE performance against the S&P is kind of difficult, as we know. There's different asset classes, different return profiles. Is it really true that PE delivered better returns than the S&P? And if so, is it only counting top quartile funds?
No, I think what we I mean, we benchmark ourselves always against, against the public markets. Because they're a proxy always when buying companies, because the seller can always decide to sell, publicly. But we have so far, I remember, I don't have the stats at hand. We have outperformed. Our returns are roughly high teens net per annum. I don't know, but I'm sure that Steffen has a even better overview than I have.
Well, this is clearly outperformance, and to the point is it's true in private equity and in particular in buyout. There's nothing more important than the selection of the right managers. So with EQT, you have, of course, one of the leading managers in the industry, and this is why you see that type of outperformance. If you take the broader average and you are not able to pick the right funds, then of course you're approaching more the market average that you're also seeing in the public markets. But this is really what we at Moon4 are proud of with our investment team and investment experience, that we are convinced that we are picking exactly the top quartile funds, which stand for the outperformance not only in the past, but we are also confident that they will be able to deliver this in the future.
Okay, great. Next question for Marcus. We talked a little bit about the money supply and stimulus at the beginning of the chat. Could you elaborate how this is potentially inflationary environment may impact returns from private equity buyouts?
As I said, I'm not really an expert in any kind of macro questions. So, I mean, look, you see inflated prices. Yeah, I mean, that's clear. If you look at these revenue multiples we have seen recently, it's just insane. It's just unbelievable. I have not seen that in my whole career. And as Steffen mentioned, I'm a veteran. That's, by the way, the only good thing with getting older is the experience point. I think we are seeing inflated, kind of inflated assets, to be honest, and that's of course a function of the liquidity which is pumped into our system, and therefore I don't think this is sustainable, and therefore I do think there will be. We will see, whether it's tax increases. We will see, some higher inflation. That will happen. But I'm sure that Steffen, he's a very, very bright person, much brighter than I am. He can even add to that.
Okay, maybe this one would be the last one we have.
Give back to you.
Yeah, maybe one last question, and then we can close for today. Are there any sectors at EQT that you're particularly excited about, or that you're targeting? And is there any reason in particular that you haven't gone into consumer goods directly?
Now, we have been in consumer goods, and we've been a so-so investor there. And we had some very good deals. Retail. Plantagen which was a garden retail chain, and XXL, a large sports retailer. But why we deprioritize consumer goods is just because of these Amazons, Alibabas, these structural challenges in the markets, and also the whole e-com development. So and probably there are other smarter ones in the consumer goods sector. I don't know whether it's JEP or other PE funds. That's the one reason. And if you then look at why we decided for the 4 core sectors, we think that healthcare is just, apart from that it is purpose-driven, like some of our other sectors. It just, we are one of the most sophisticated healthcare investors, and we really decided, okay, there's pharma, there's medtech, and within medtech there is audiology or orthopedic implants or whatever, or dental implants. So we are going really down in themes and try to have a thematic investing approach. And the same in the technology sector, where we have specific software verticals, or where we have classifieds, which we like, even losing Scout, we didn't stop and did then Idealista in Spain and Casa IT in Italy. And so we have very, very dedicated themes, or in the industrial tech space, for instance, robotics with a very good robotic grip company, or AutoStore warehouse automation logistic company, or Christian Hansen Natural Colors, also in the industrial tech space, so natural colors, nothing else, so coming from plants. So this is what we really like. So we like to invest with the trend, but industrial tech, we are a little bit more careful because it's a little bit more cyclical per se. So it's, we don't have a high exposure, and then some service business models we also like a lot. Anti-C-Max, a pest control business, or the IVC, as I said, the pets clinics. It's between healthcare and services. So these are, we like these kind of themes, and we always try to develop new themes within the sector. So it's a constant dynamic process.
Markus, terrific. Thanks so much. And to the audience, stay safe. And hopefully in some point in time, we can do this format all together in a room again. Stay safe and hope to see you very soon at our next Deal Talk. Thanks a ton.
Likewise.
Thank you all.
Thanks for listening. For more episodes, search for Deal Talk wherever you listen to your podcasts. Want to know more about investing in private markets? Visit moonfair.com.